Hello and welcome to Investing Confidential. Well, finally, the Dow winning streak is over. Longest since January, or beginning of 1987. I mean, that's not bullish because in October of 1987, the Dow, the market itself, the S&P, whatever the hell you want to call it, was down over 20% in one day. So we're headed we're headed in the wrong direction here, folks. Despite this winning streak, okay. Why was the Dow up? Well, look, the algos had a lot of catalysts. Okay. And when I say the algos, look, if you don't believe this is machine driven trading, you haven't been studying the market long enough. Okay. The algos, the AIs, these machines have been driving the markets for quite some time. They're news algos, they're based on catalysts, etc. And look, everything's been positive for the algos, right? The biggest one was the Fed. Okay. Market history tells you when the Fed ends the rate cycle, there's normally a big rally coming, right, in the future. Well, there's a mistake here because the Fed is not ending the rate cycle anytime soon. Okay, and look, I'm going to show you why this is the case. I'm going to show you again a very important reason why the market ended the streak. The biggest risk to the market is something that, if you've been following my videos a number of months ago, or at least a month ago, sorry, I showed you the news that was coming. This news should have been anticipated because what happened, the announcement in Japan, which was really the catalyst for the market correcting and reversing and losing streak, is something that we've been waiting for. All right, I mentioned it as a risk. And more than a risk, said it was happening, and it finally happened. Okay, so first, let's talk about the market sentiment. It's turned very bullish, okay, which is a red flag. We've been looking at this market sentiment for quite some time as a reason to be in the market. It was obviously very bearish. This is why I told you guys the market wasn't going to come down no matter how bad the economy was. It kept going higher, and it has been going higher. And this winning streak, okay, it's been great for traders, okay, but it's worrisome, as I mentioned. And it's going to be a problem because think about the Dow, right? It's 30 companies, big companies, okay, and it goes into this thesis, as I mentioned, what we call market breadth. Okay, look at this chart of concentration, mega caps. Okay, mega caps essentially the Dow, and look at the mega caps in the S&P. It's the highest in 40 years. Okay, higher than the tech bubble. Combine this with the Magnificent Seven tech stocks driving most of the market. It's very scary. Okay, very powerful move, but very scary because this is very unhealthy for the market. Okay, and everyone's bullish. Okay, look at institutions. The NAAIM, which is an institutional, seeing who's bullish. And they're very bullish. These are institutional money managers, very bullish. Okay, here you see risk sentiment. Okay, extremely bullish. And there are others out there. I mean, so the continuation of his rally after the extreme bearishness was obvious. But what now? Okay, everyone's bullish. So what now? Before we answer that, let's look at the Fed, the inflation situation, which is obviously why this news, which was misinterpreted, by the way, why the market rallied before the Fed and after the Fed. And then obviously the news today was a big reversal. Okay, so look at inflation, the CPI. It's a manipulated index. Obviously, it's been coming in because it is what it is. Again, an index that really isn't a really good index, but it's coming in. And it's the best indicator of inflation, is it? I mean, no, I don't think so. But as I stated, a week ago, inflation right now is being, we're going to see inflation be stirred by the weak dollar. Okay, and the weak dollar for many reasons. Is this the end of the rise in rates? I don't think so. Okay, the weak dollar is going to keep inflation at very sticky levels, especially with commodities, which I'm going to show you now. And I don't think rates are going to come in. I mean, the market wants them to come in, but they're not. Okay, and if you look at why the U.S. dollar is been very weak. It's for obvious reasons. Look, I mean, I've showed a number of charts. I'm not going to show the same charts over and over again, but you've got interest costs, okay, on the U.S. Treasury, on our debt is skyrocketing, okay? And then here's a chart I'll show you how to look at tax receipts. They're plummeting. So we've got interest costs going through the roof, and our tax receipts are plummeting. That's not good. And again, I still predict a downgrade of this debt. It's coming. So whatever the reason, the US dollar is on a downtrend, okay? And it's inflationary. It doesn't make sense, but it's look at commodities, okay? Here's orange juice, the highest price in 10 years. Here's cocoa. Okay, cocoa is used by in almost in everything. Again, another 10-year high. Okay, and here's the chart I showed last time. Metals starting to pop. Okay, again, weakened dollar. Here's copper. Now, this is the interesting one. Copper is spiking despite the Chinese economy having major problems. Now, Dr. Copper, as they call it, usually goes along with the Chinese economy. Chinese economy is destroyed right now. Okay, it's at a bottom. The currency's at a bottom, and yet copper is spiking. This is, again, for someone in US dollars, this is a problem. Okay, but the big one here is crude. Okay, crude is about to break a downtrend. If you haven't noticed, gasoline prices are going up all over the US. Okay, inflationary. So the market celebrated lower CPI, lower inflation. It's going to come right back. Okay, is it going to spike up back to 9%? No, of course not. But it's going to stay, I keep using that word, sticky, sticky, sticky for quite some time. So commodities overall are starting to take off. And by the way, here's a interesting reverse indicator. Look at investors. Okay, they're very underweight commodities. It's a good time to get in, folks. If you haven't, emerging markets. I'm gonna do something on international equities very soon. But emerging markets, commodities are linked, and it's time to get into commodities. But let's get back on track here. The Fed raised rates the last session because they see these things. Okay, they're seeing things that you don't see, that investors don't see. And I got to clap for the Fed because despite they have the head of the Fed being a dove, he is a dove. You can't get away from what's happening. And the big thing here, the Fed is wages. Okay, wage inflation. You can't deny it. Okay, it's going higher. Okay, I mean, you look at these charts on wage inflation and you just scratch your head. And then look at just what's happened recently. Okay, UPS, there was a big strike, potential strike. It was averted. Why? They wanted higher wages, and guess what? They got higher wages, significantly over inflation. So, the rates are up. There's no cuts coming. Even the Fed's been no cuts coming for 2023. Despite Wall Street and the White House want to see rate cuts, they tried to fake a fake banking crisis. It didn't work. Okay, but there's going to be no rate cuts. And all you have to look at it, go back to something I've been mentioning ad nauseam for months, the terminal rate. You've got to watch this terminal rate. Despite it coming off recently, it's going to go higher. It's going to hover around these levels for quite some time. It's hard to see it coming in. And then you got mortgage rates. Okay, mortgage rates are not coming in. And real estate's another story. Okay, mortgage rates are not coming in. Again, all this points is higher rates, higher inflation for longer. Now, is the Fed going to raise significantly? Hard to say. There's a lot of pressure on the Fed not to raise anymore. But are they going to cut rates? No chance. Okay, and now let's analyze specifically this news that broke the Dow winning streak. Okay, and it's going to have, again, increased pressure on our bonds, which again will keep rates higher. So in Japan, the Bank of Japan is indicating that they're going to break this artificial cap. Okay, on JGBs are their base bond. It's like our 10-year treasury. Okay, and they've been holding it at 50 basis points. I mean, it'd be like the Fed would have held our 10-year at 2.5%, 3%. It would be with inflation raging. It didn't make any sense. But this is Japan. Okay, this is Japan. Inflation for Japan's a real issue. Okay, look at here. You got the first time since 2015 that Japan has higher inflation than the U.S. Okay, inflation in Japan is almost 4%. Okay, here are Japanese wages. They're spiking. This is causing the BOJ, the central bank, the Fed, the Bank of Japan's Fed, to realize that they cannot continue this suicide. They have to break this cap. It's insanity. Okay, and financial repression. This is the art of the government forcing its own institutions and the private sector to buy its bonds, despite a terrible investment. They force them to buy it. It's called financial repression. This is the experiment. Okay, it's over now in Japan. Just like low rates forever, which never worked in Japan, meaning low rates never got the economy going for almost 30 years. That's over. So, and interesting what's happening in the rest of the world. Everyone adopted the low rates. Didn't work anywhere. And now you're going to see, as I mentioned to you before, financial repression being adopted in the US. Okay, it's a failed experiment. Japan is showing you its failed experiment, but no one seems to care. But we are headed for the same thing, financial repression. So what does this all mean? Japanese institutions are already bringing money home. Okay, they're the largest holder of our bonds, and the pressure on the bond market is going to be intense. Okay, but if you watched I did a couple of videos on this whole thing with Japan, produced in the past. I told you about this risk. Okay, the causes and effects, and it's a major problem. So if we have rates at these levels for quite some time, what's the result? Well, we're seeing it already. U.S. bankruptcies are surging. Okay, it's the highest since 2010. Okay, almost 13 years in the first half of this year, the highest since 2010. We're headed for a record bankruptcies. That should worry everyone. How is this economy holding? Well, look, as I told you before, there's no liquidity. Okay, the market's being manipulated by the algos. They just come in and buy. We have the highest rates in 30 years. The economy is reeling. The housing market stalled. It's about to collapse. There's no buyers, there's no sellers, meaning there's no liquidity in housing. There's no liquidity in treasuries. There's no liquidity in stocks. People are manipulating it. You can manipulate the stock market. You can't manipulate housing. So we're going to see a collapse there coming as well. And I know I keep mentioning inflation, but I still believe, and I'm going to end this, that the weak dollar, okay, the weak US dollar and deflation is the biggest risk we're going to have, okay, by far. And I think I mentioned in one of the first videos, I told you that big inflation is coming, but down the road, deflation is going to be a massive, big problem for the US. And I firmly believe that. I firmly believe that the market has peaked. I would be in cash right now. 5%, 5.5% for short-term treasuries. That's what you want. Okay. We're going to come into a major correction sometime now in the fall. Okay. August historically has been a very tough month. Why? Because earnings season started in July. And as you digest the earnings season, as you're going to see, okay, as the mainstream starts to report, small companies start to report, you're going to see not good. So all these things, the Japanese thing is a problem. If you would watch my videos, you know way ahead of time, you know it's a problem. So the market is telling you something here. Okay, so everyone's bullish. You should be bearish. Everyone's piling into the market. You should be coming out. That's the reality. So investors, be careful out there.